Stay like Bloomberg.
24 seconds away from the opening bell this morning. Good morning. This Thursday morning, CPI data's come out bang in line with expectations. Equity futures off the back of it, just about positive by 0.2%. Putting together 2 days of gains coming into Thursday. Can we make it 3 on the S&P? As your opening bell, switch at the border, get to the bond market. Yields shaping up as follows on a 10-year yield in America. Down 3 or 4 basis points, sub 350 a little bit earlier this morning. 350.41 right now. The high of last year, the 10-year peaked at 433 back in October. We're well below that level now by more than 80 basis points. In the FX market, euro dollar, hello, 108, 108.19, 108.20 on euro dollar, up 0.6%. This dollar weakness that's kicking in is real. We're going to pick up on that story in just a moment. Crude right now approaching 79 on WTI, up by 2 percentage points on the session. That's the cross-asset price action. About 30 seconds into this one, we advance about a third of 1% on the S&P. On the Nasdaq, up a third of 1%. Also, one stock to watch at the open, it's Disney, the company facing a proxy war with activist investor Nelson Peltz. For more on that, here's Abby.
Hey, John. Well, yeah, it looks like it's going to be a battle, and with the stock higher right now, up more than 2%, it suggests some shareholders and at least one analyst on Wall Street agree with Nelson Peltz's view. Now, they, of course, did this morning, Trion Management, file a preliminary proxy statement urging shareholders, other shareholders, to support his nomination to the board. Some of those other shareholders, Vanguard, BlackRock, State Farm, Newport, Royal Bank. Now, currently, Trion Management has a roughly 900 million stake. That would put them right around 22 or 23. So a pretty big shareholder there. And they are criticizing a number of factors right now. First and foremost, they really want a Bob Iger succession plan put in place. They're also talking about excessive compensation and the fact that the company has perhaps overpaid for some assets, including some of those 20th Century Fox Media assets. Now, relative to paying for them, the debt is high. This could be another issue. Right now, Disney's long-term debt about $49 billion. So relative to the stock, though, this is another issue brought up in that preliminary proxy statement. Since its peak, it is down, and this came as a surprise to me. It's down 50%. I mean, it's a really pretty incredible decline at this point, so it's going to be interesting to see how this plays out. And Nelson Peltz is known for having won some of these proxy wars in the past. They're not for the faint of heart, and it'll be interesting to see whether or not he convinces other shareholders to allow him to be nominated to the board.
Brutal 12 months. Abby, thank you. I started the show by saying no fireworks. You want some fireworks? You want some price action? Bed Bath & Beyond. Monster move. Have a look at this. Up by 15%, and have a look over the last 3 days as well. Katie Lyons, explain this, please.
I wish I had a good explanation for why fundamentally this was happening, John, but it has indeed been remarkable. This 15%, actually now 17% gain today would be the smallest we've seen in 4 days, a 4-day period in which we have seen this stock rally 200%. It was up 69% yesterday alone, a record day of gains, and really for no good reason, considering last week this company warned it was maybe going to have to file for bankruptcy. Then we actually got results from it this week that showed a wider loss than expected, the company attributing part of that to its inventory struggles because suppliers have lost trust in the company's ability to make payments. Sales growth also has been floundering. So do fundamentals really support this rally whatsoever, John? The answer is no. Maybe we can attribute some of it to a short squeeze, given that short interest in the stock has been rising and is now about 52% of float. But mostly it just seems like meme trader behavior is making a comeback, because this has extended beyond Bed Bath & Beyond. We've also seen gains in the likes of AMC and GameStop, even Carvana rising as well. So meme stocks as a group actually have had a pretty solid start to 2023, up about 10% so far. That only goes so far, though, to undo the damage that was done to these names last year. That meme ETF down more than 60% in the last 12 months, John.
Bed Bath & Beyond up about 20% right now. Katie, thank you. 3 or 4 minutes in then, about unchanged on the S&P, almost negative now on the Nasdaq by about 0.1%. Some good news for the airlines after a rough couple of weeks. American Airlines beating estimates in its prelim results on robust holiday travel demand. Ed Ludlow, these numbers pretty impressive.
Yeah, they are impressive. If you take the group as a whole, that group of US-listed airlines, they're on track for their 7th straight day of gains, which would be the longest winning streak going back to August of 2020. I like some good news at this time in the week, Jonathan. What's interesting is what the story is here. The EPS range for the fourth quarter, $1.12 to $1.17, almost double what the street was forecasting. Again, these are prelim results from American Airlines. But what they're talking about here in the story is, A, there was demand over the holiday period, which is interesting because we're kind of trying to get a sense of how the consumer's doing right now, but there is some specifics within that, which is these are not big corporate accounts and business travel that is boosting American. It's actually SMEs, small and medium-sized businesses, along with that leisure.
Look at the median company or the typical company, it's actually expecting to see a 3.5% increase. So what it really means is that the really big companies are having a harder time on earnings. And if you're a portfolio manager and you have a whole bunch of stocks in your portfolio, the majority of them are going to beat to the upside overall. So that's going to be one big theme. A second big theme is that tech companies have been a source of downward revisions, meaning that the earnings estimates for tech companies have been falling a ton. And in the last quarter, not only did they fall a ton, but then they missed the lowered estimates. And we actually think that that's going to continue, that tech is in kind of a a sour patch, if you will, for several quarters. Now, on the other side, even though the price of oil is down, over the last 3 months or so, and gasoline prices is down over the last 3 months or so, the energy stocks, their earnings, their expectations are ripping. And we think that they'll actually surprise on better numbers. So there's a number of different themes. The headline will be worse, but at a company level, things will be okay.
So, John, let's just build on that. If tech can't regain leadership and last year's winners, energy, can maintain momentum, that's going to leave the index pretty challenged, isn't it?
Yeah, I think, Jonathan, so first of all, well, we see the index from an earnings perspective, we think the numbers are going to be down. But we found, we just did some research on this, that the majority of the years that when earnings are up, the multiple contracts, or when earnings are down, the multiple goes up. As odd as that actually sounds. Last year, the earnings weren't great, but they were okay. And the market was terrible because the earnings came down. I'm saying the multiples, the PEs. So why did the PEs come down? Is because last year, the cost of capital, your 10-year bond yield, started the year at 1.5 and ended the year at 3.9. Did this huge increase in interest rates, and it knocked down the valuations of companies. This year, we think the opposite is going to happen. We've already seen interest rates fall. We're seeing that, even today and yesterday, and that's part of the reason that stocks are off to a good start. It's not because earnings are good. It's because interest rates have rolled down a little bit, and people tend to not focus on that.
And with that, John, the dollar's weaker, a whole lot weaker from its peak back at the end of September. Is that going to be a factor this earnings season? It's pretty well understood. We can all see it on the chart. Where's it going to show up?
It's never as big as we make it out to be. Roughly speaking, a 10% move in the dollar is about a 1% move in earnings. So the dollar, as U.S. inflation has been falling, the expectation is the Fed has to do a little bit less, and the dollar weakens on that. That's incrementally good for corporate profits, but maybe that gives you 20 or 30, 40 basis points of earnings. It doesn't really change the overall earnings season, but it does make U.S. companies a little bit more productive. And you may hear some of that in the language from companies, but it really doesn't change the picture that much, Jonathan.
Hey, John, it's good to catch up. Jonathan Golub there, weighing in over at Credit Suisse. Appreciate it, John. As always, buddy, your broader equity market down about 1/3 of 1%, 12 minutes into the session. We move on pretty quickly from CPI. The next stop for this market, of course, is JP Morgan tomorrow, Bank of America earnings. Then on to next week, we'll hear from the likes of Morgan Stanley and Goldman. Then on to the week after that. The week after that, we start to focus on tech, Tesla, Apple. Do you want to call Tesla a tech company? I don't know if you do. But Apple in early February is going to be a massive focus given the weakness we saw at the back end of 22. In the bond market, a rally on a 2-year. Yields lower by 5 basis points. Right now, 416.55. 10-year basically unchanged at 353.54. I mentioned that weakness we're starting to see in the US dollar. You can see it right the way through G10, particularly on the Japanese yen. Dollar yen has had a 1.5% move today off the back of a local report in Japan suggesting there might be a policy review of the BOJ as soon as next week. And now there are all these calls, particularly from Citi. Tom was talking about that a little bit earlier this morning, that maybe yield curve control gets dropped completely. The Japanese 10-year new threshold, 50 basis points. This market is pushing right up against it. Keep an eye on that one. Coming up on this program, positive signs emerging in the semiconductor place.
It seems that there is a consensus at the moment that the recession is going to be a mild one. Then the impact on the semiconductor sector probably is going to be a mild one as well.
We'll talk chips up next.
there is a consensus at the moment that the recession is going to be a mild one, then the impact on the semiconductor sector probably is going to be a mild one as well. Chip makers like TSMC or Samsung are not really adjusting strongly their capex. This is a war between the leading edge chip manufacturer. They have to be in front of the race, so they keep on spending.
Auto earnings offering a mixed outlook for the industry. Taiwan Semi planning to cut spending, but the CEO striking a more optimistic tone, seeing an end to the chip crunch. It's a similar story for VW. The automaker expecting supply bottlenecks to ease despite sales plunging to an 11-year low. Team coverage starts right now with Bloomberg's Ed Ludlow here in New York alongside Craig Trudeau in London. Ed, what are we learning on the chip front?
Yeah, it's a mixed picture, isn't it, on TSMC? They are cutting capex for a range of $32 billion to $36 billion, down from $36.3 billion in 2022. They're talking about a decrease in sales in the first half of the year and slight growth in the second half of the year, netting out at slight growth overall, less than single digits for the full year. Sales are going to be between $16.7 billion and $17.5 billion for the fiscal first quarter, below analysts' consensus of $17.9 billion. So it's not clear whether the market, you look at the US listed shares of TSMC, the ADRs were up 5%, other chip makers lower. I guess given the outlook broadly for consumer electronics demand, are they cheering that cutting capex? It's only very slight. On the other hand, as you say, when we look at the auto sector, and these are pretty basic semiconductors, things that are processors translating the push of a button to an electronic signal, actually we see more availability of supply and growth in that market in 2023, which of course is a boost for some of the automakers who left vehicles on the concrete, right, waiting for those chips to come through before they can be sold.
Craig, do you think these automakers will get some relief sometime soon?
Yeah, I think you look at what happened with Volkswagen sales last year, an 11-year low for them, 7% decline to just over 8 million. This is a company that for years in the lead up to the pandemic was doing 10 million plus units a year. And we know that this is a supply issue from just looking at the order book. They talked about 1.8 million vehicles just here in Western Europe that are ordered and awaiting delivery. So we know that, of course, this is a company that has had some issues with product appeal in China, has had some issues with software that, potentially are costing it some customers. But this is absolutely the case that they also have some demand that they've been unable to meet because of the semiconductor issue continuing to give them problems.
The other big question as well for companies like Tesla is how much capacity do they need? Bloomberg learning that an expansion of Tesla's plant in Shanghai has been delayed over data concerns. Ed, can you run me through that one?
Yeah, I think that data concerns, this is an interesting one, reporting from sources over in Asia. I think the risk here is that you pump out vehicles at high volume that then don't get delivered, right? We know that in China, while there's been supportive policy and pullback on the COVID zero, the consumer is under pressure, but also there's a risk of the spread of the virus, which has impacted overall EV sales in that market in the months of November and December. There's a column out this morning from our colleagues at Bloomberg New Energy Finance, which says basically overall, globally, we'll see a slowdown in the demand we saw in 2022 for electric vehicles. Whether Tesla actually has a demand problem, we don't know. All we have to go on is the reporting. They've used the lever of price cuts, which is indicative that they are worried about the need to at least catalyze some new demand going forward, particularly in China.
Craig, let's finish there. China reopening. Is this the game changer or not? Can we just put a bow on that?
Yeah, I think there's absolutely the case that some car makers have pointed to this idea that they've just not been able to get, people into showrooms. They've not been able to get staff into those showrooms or into offices. So will we see an uptick in some activity? Absolutely. I think the question, to Ed's point, is whether or not some of the issues that, predate the most recent sort of round of lockdowns still have an effect on that market. When you talk about the property bubble, and the sort of air coming out of that Musk pointed to quite a bit toward the end of last year, whether or not that continues to be, something that plagues the industry going into 23.
Hey, Craig, thank you. Craig Truder over in London, Ed Ludlow here in New York. Thank you, gents. Appreciate it. Tesla getting hammered this morning again. The broader equity market totally rolling over here. We're down 0.6% on the S&P. On the Nasdaq, we're down 1 percentage point. Abby has the breakdown at the sector level. Hey, Abby.
Hey, John. Well, not surprisingly, we have most sectors lower with this decline. It sort of feels like it's out of nowhere, but it is somewhat substantial, down 0.6%. Now, the worst sector, healthcare, down 1.2%. We then have discretionary, tech, and communication services. So not surprisingly, those are your heavyweight tech sectors, the big weights to the S&P 500, and therefore you have the index lower. Energy is up 1%, as oil is also up 1.2%. But you know where I want to go? I was going to take a look at those techs rolling over, but they're not huge declines. The bigger declines are smaller names. Take a look at these moves on the year. Now, does this look like a recession to you, John? We have the airlines, as we've been talking about, up 18% on the year. Metals and mining, an expectation of the global economy, up more than 15%. And then entertainment and leisure products, all sharply higher. It does not look like, so far, investors are planning for a recession. Let's see what happens.
Hey, there's some big moves, aren't there? It's early days, but they're big moves. It's only January 12th. I keep saying that. We're already questioning the consensus view. You can hear the cracks in it. About 23 minutes into the session, we're down 0.7 on the S&P. The Nasdaq now down by more than 1%. Coming up, your trading diary. Guessing the data is one thing. Anticipating how the market's going to react to it is quite another. In line on inflation, right across the board, slap bang on estimates. Your equity market's lower by 0.75% on the S&P. On the Nasdaq, we're down by 1.3%. That's the price action. Here's the trading diary. President Biden delivers remarks on inflation at the top of the hour. Plus, we hear from Fed Presidents Bullard and Barkin. More Fed speak from Williams, Kashkari and Harker. Coming up tomorrow, and it's the big banks tomorrow morning too. JP Morgan, Bank of America, Citi, Wells Fargo kicking off earnings season. And finally, to get you to the weekend, we'll get you some UMich Consumer Sentiment Survey results to round out the week. From New York City, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
experts, great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, January 12th. Here are the top market stories that we are following for you at this hour. Feeling cool, cool, cool. Inflation slows down again, even though shelter prices stay sticky. Equities lose gains. Yields are mixed. We're going to get the view from the White House with Cecilia Rouse, chair of the Council of Economic Advisors. And bye-bye 75, hello 25. Philly Fed President Patrick Harker throws his weight behind a 25 basis point hike in February, saying the days of oversized moves are a thing of the past. And the unmagical world of Disney, Nelson Peltz faces off with Disney as he tries for a seat on the board and goes after Bob Iger's compensation. We get the latest. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I feel like the equity market in some ways is easier to understand, right? We were positioned one way and now we're unwinding some positions. But the bond market, to me, I wonder if the bond market is telling us we're going to see a soft landing, and I wonder how that's going to play out.
Well, in some ways, you could argue that today's data do point us in the direction of a soft landing. You've got inflation coming lower, but you've got the claims data appearing to be fairly good. The labour market is still tight, define good here. The labour market is still tight. There are still jobs out there. Claims are not spiking higher. Inflation is coming down. That looks like a soft landing to me. However, Alex, I'm really scratching my head here. Every time we have a conversation with somebody in the oil market, they tell us the oil prices are going sharply higher from here. The administration has already spent effectively the SPR. If oil prices go higher, gasoline prices go higher, headline inflation goes higher, and it's core that's sticky. So I don't know whether or not we can be declaring victory just yet.
Well, also, I mean, the services picture in terms of housing as well, we're all waiting for it to roll over. We know that the Fed's backing that out, but when? When is that going to peak? And when it rolls over, how quickly does it actually come down? Anna Wong of Bloomberg Economics is looking for the spring. The spring feels a really long time away at this point.
Absolutely. So I wonder whether actually we can find ourselves in a situation where it becomes harder to manage this kind of move lower and for the Fed to force it, or whether or not it's actually going to do more. Harker's talking about the fact that we're moving to 25. He's talking about the fact that it's kind of 75. That's very much in the rearview mirror. Collins is saying the same kind of thing. But I just wonder whether or not this is going to be a bumpier year for inflation. It's not all going to be in one direction. Last year it was all up. This year it feels like it should be all down. But I just wonder how choppy that journey could be.
Yeah, no, indeed. And also, then this is exactly what we're seeing in the equity market. We are front-running a deeper decline in inflation, and then obviously you're seeing some disappointment then eventually sort of shake out, and we didn't get that, to your point.
Absolutely. You don't want to hear it from me, though. You want to hear it from Harker. So Patrick Harker, Philadelphia Fed president, speaking as the numbers drop. This was his take on where we are with inflation and where rates should be going.
I expect that we're going to raise rates a few more times this year. Though, in my view, the days of us raising them 75 basis points at a time are surely past. In my view, hikes of 25 basis points will be appropriate going forward.
We probably are into the finessing phase of this kind of story, but it is going to be maybe more lumpy than maybe we're thinking about at the moment. So our question of the day is picking up on what Mr. Parker had to say, picking up on what others have said. Collins, I mentioned there's a few other names out there as well. Is it 25 now? Is that nailed down? To discuss, we're joined by Kriti Gupta and Bloomberg's Mike McKee. Mike, let me start with you. Does today's data signal a soft landing? Does today's data nail down 25?
Oh, two different questions. Yes, it nails down 25. I think there's no reason for the Fed, which had signaled 25 to begin with, to change and go to a stronger move at their February 1st meeting. Soft landing remains to be seen. And part of that is, as you and Alex were talking about at the top of the show, what is a soft landing? How do you actually define that? But in the numbers today, we are seeing good news. You guys were pretty gloomy, it seemed, to start the show, or at least skeptical. If you take the core rate, say, on a 3-month moving average, you are looking at 3.5%. annual rate of inflation as opposed to the 5.7% core rate that we're seeing on a 12-month basis. So in recent months, there has been significant progress made, and that's likely to continue. Now, at the pace it's going, no. It's going to be bumpy. Things are going to go up and down, but it's still going to keep going down because most of the categories contributing to this are starting to fall. And Alex, to your point, that when does housing come down? Doesn't matter, because the Fed is looking through housing at this point. They're looking at the more contemporaneous numbers showing rents are coming down. They know it's going to happen, so they're not going to be basing policy on what happens to housing in the core rate.
I know. Apparel prices were still sticky. I'm just saying.
For guys.
For guys. See, guys shopping.
For men's clothing this time.
This is outrageous.
We were really surprised.
I can't believe this is happening.
Yes. And
this is why I don't shop, because prices are going up for me. Alex Steele going out, doing the sales, got a big budget. Yes. That works.
No, it's a small budget. Okay, Kriti, talking about the market reaction here. I was labeling the equities as positioning and then maybe the bond market looking at a soft landing. What's your take on it?
Yeah, I think that's a pretty fair take, especially on the equity market where you are starting to see a little bit more, not to use the word sticky again, but sticky reversal where you actually are seeing a lot more gains. I mean, the consensus here, especially in the first half of this year, has been this idea that we are still due for another leg lower in the stock market, that the S&P 500 has not yet bottomed out, and that the real recovery is going to come into the back half of the year. That is not the case in these first 2 weeks of January. You have actually seen a rebound that comes faster, and a lot of it is centered in the idea that the Fed's hiking cycle is coming to an end, which really supports the idea of that 25 basis point hike that is now priced in to a 90% probability.
Kriti, today's data is terrible for companies, I think. Because you've got a headline inflation number that is coming down. You've got inflation that's coming down. That removes the ability of companies. That's basically signaling that companies will not be able to raise prices. Yet the labour market still remains tight, which basically signals that costs are going to remain a problem. That sounds like it's dreadful news for the bottom line.
Well, on the surface, it sounds like that. But remember, a lot of this has actually been prepared for and priced in a year in advance. And as you start to see the year-over-year, at least, numbers come down further and further, think about what that does then to the consumer psyche. And this becomes a little less quantitative, a little less tangible. But the idea here being that as you start to see essentially the wealth effect that diminished going into 2022, end of 2021, that is actually going to come back a little bit. As you start to see inflation come down, groceries get cheaper, clothing getting cheaper, even travel coming down a little bit. The baseline idea is that the American consumer is still going to be spending. At the end of the day, this recession, whenever it does arrive in the United States, is going to be a shallow one because at the end of the day, the consumer is still spending and not pulling back to the same extent that I think was priced in last year.
I'm just really concerned about that. If that top line goes down, companies are going to have a real problem. How many more levers do they have to pull in terms of cost? Mike, to that point, I'm looking at WIRP, and now we're looking at a definite cut priced in now for July. How does the Fed downshift to 25, deal with inflation that is slowly rolling over, and also talk out a cut for the back half of this year?
Well, talk is what they can do at this point.
It's not working.
It's not working at this point, and it kind of works against them because financial conditions ease. One important thing that Pat Harker said that hasn't been mentioned is that they do need to get rates over 5%. And right now they're at 4.5%. So it's not just one 25 basis point move, it's at least two. And then they want to leave it there for a while. Now, the wild card is, and this may be what the market is thinking, inflation is going to come down faster than the Fed anticipates, either because inflation is coming down fast because companies are not raising prices, or because we're going into recession. Now, if you're going to buy the soft landing story, we're not going to go into recession, and therefore the Fed could lower rates, but it doesn't have to. If inflation's going down and the economy's in good shape, they're not going to be pushed to lower interest rates. And so there's going to be a lot of back and forth between the markets and the Fed over the next couple of months.
I hear what you're saying about what Harker's saying about the fact we need to get north of 50. But Kriti, let's talk about the dollar for a second. I've got the Fed kind of downshifting. As we said, number of speakers have been confirming that in the talks that they've been given. If you listen to what the ECB is saying right now the ECB is playing catch up here, but nevertheless, the ECB is now sounding more hawkish than the Fed. Does that signal a downdraft, a continuing downdraft for the dollar, do you think?
It absolutely could, especially when you start to see a lot of people, a lot of the equity strategists that are saying, well, look, you're going to wait for this kind of turnaround in the stock market, one that is going to be primarily led by cyclicals. If you believe in the cyclical trade, you are also, by extension, a big assumption here, positive on Europe, which by definition is more exposed to that cyclical trade as well. So that encompassed with the point that you're making, that essentially those ECB hawkish comments is going to strengthen the euro a little bit, which, by the way, we've already seen. It has made some way from parity from last year. That dollar story, though, is rooted at the end of the day with those Fed expectations. As you start to see those terminal rate expectations stalling out, it builds the case for a bear market when it comes to, or at least a pullback. Bear market is a tough term, but a pullback when it comes to the dollar, which then reinforces the case for a stronger equity market, because that inverse correlation between the dollar and the equity market is still there. What you haven't seen is those funds coming from abroad, the European investment, the Asian investment coming into the American market, which is pretty typical during recessionary periods. We haven't seen that yet. And of course, if you start to have a weaker dollar, those investments are much, much easier to make from abroad.
Guys, really fun roundtable. Thanks a lot, Kriti Gupta, Michael McKee. We appreciate your time. Thank you. Coming up, more on inflation and the market's reaction, as well as do with the Fed. Kara Murphy, Kessler Holdings CIO, will be joining us. This is Bloomberg.
Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
We got an inflation report exactly as we expected. We also got a reminder that the labor market is running pretty hot. From the Fed's perspective, aggregate demand has momentum. That's putting pressure on resources. That will put pressure on wages and therefore on prices. Maybe not this month on prices or wages, but the mechanics are there. The mechanism that you worry about inertial inflation is there.
That was Dreyfus and Mellon Chief Economist Vincent Reinhart earlier on Bloomberg Surveillance after that CPI number crossed. And that turns us to the question of the day, 25? Question mark. Joining us now, Kara Murphy, Kessler Holdings CIO. Kara, is this number good enough for 25 now?
For sure. I mean, this number came very much in line. We can quibble about a little bit higher here, a little bit lower there, but very much in line with expectations. And so I think the Fed has a clear path towards 25 basis points going forward. I would say, though, I think today is the day that inflation jumps the shark in terms of its importance on the market. It's not that it's not still really important, but it's very clear we've had multiple months of decelerating price increases, that the Fed is starting to downshift from 75 and 50 to 25. We have a clearer path ahead. The bigger question for 2023 is going to be, what's the impact on final demand for companies? What are they going to be able to earn in this tighter monetary environment? And I think that's going to be the big question mark.
Okay, there's two different things I'd like to talk about there. First of all, let's deal with this kind of narrative that inflation is going to come down. Cara, if I talk to people in the energy market, they tell me that gasoline prices are about to go sharply higher. Most of the analysts we talked to, and it was Jeff Curry at Goldman Sachs yesterday, tell us that Brent crude is going well north of 100. It's much lower than that now. We are going to see energy costs moving sharply higher as we move through the beginning part of this year. Are we sure that we've got a handle on inflation here?
So energy can kind of do its own thing within the broader inflation picture. So as energy goes up, it certainly takes a bite out of consumers' wallets, so they have less discretionary spending. So that can hurt the overall top line for the broader economy. From an inflation perspective, the concern is that those increasing commodity prices then start to filter into other prices, which is exactly what we saw over the last couple of years. But going forward, you have to believe that those higher energy prices are then going to cause, end retailers to start raising prices. And I don't think that's going to be the case. I think more than anything, it's going to eat into consumers' wallets. You see less discretionary spending, but not a continuing price inflation.
So, Cara, are we supposed to be pricing in a soft landing now within the market?
That's exactly what the question is. So we still think that into 2023, we will see a recession. All of the very strong indicators that have been pretty reliable over multiple cycles are telling us that we are in for a harder landing. Won't say super hard, but if you look at yield curve, all across the curve, multiple different ways to measure it, we're seeing deep inversion and for an extended period of time. We're seeing things like ISM plummet in many ways, suggesting that final demand in the U.S. and around the world is really weakening. So we do still think that we're on track for a recession, but that's really what's going to be driving prices going forward. It's not so much where inflation is.
Yep. How overinflated do you therefore feel that earnings expectations are still in this market, Cara?
So if you look at current expectations for 2023, expect about 5% growth. So that's down from where they were 6 months ago. They were, about 9% in the middle part of last year. They're below longer term averages. So all of that is good. But when you look at previous periods when you've had an earnings recession, they've never sort of dropped only a little bit. Even in mild earnings recessions, earnings declined 10%, and we're talking about expected growth of 5%. Now, again, we don't expect something along the lines of the bursting of the tech bubble or global financial crisis when earnings were down, 50%, 90% during the global financial crisis, but we do think that earnings at least have to be flat to down for 2023.
Where then in that case, what sector is going to benefit the most as we head into this lumpy area that it feels like many are trying to front run? So that's also hard to understand in terms of the price action.
Yeah, for sure, because we've seen a lot of these more defensive sectors, think like healthcare, consumer staples, that have had a little bit of a run. They've outperformed fairly well in 2022. So there's a nice valuation differential now that makes it a little bit harder to buy into those types of sectors. So on the equity side, we're actually starting to leg into non-U.S. equities, where you still have, really low valuation differentials. You were talking before about those central banks now raising interest rates. You have really nice dividend yields on a lot of those names. So we think on the equity side, there's actually more opportunity outside of the U.S.
Cara, there's going to be no jumping of the shark on this show. Let's just kind of start and finish with that one. Thank you very much indeed. Love the analysis. Cara Murphy, Kessler Investment Management, CIO. Thank you very much indeed. We need to talk about Disney. Peltz versus Iger. That certainly seems to be the narrative now. Activist investor Nelson Peltz wants changes at Disney. He's nominated himself to the board. He wants significant cost cutting. He wants profitability. We're going to talk about this next. This is Bloomberg.
Time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Some rare good news for crypto enthusiasts during a dark period for the industry. Bitcoin has risen for 9 days in a row, the longest winning streak since 2020. The world's largest token is up almost 10% this month to over $18,000. Last year, Bitcoin fell 64%. Bloomberg learned that T-Mobile may buy the budget wireless carrier backed by actor Ryan Reynolds, Mint Mobile. The second largest U.S. mobile service provider has been in talks with Mint, but no final decision has been made. Reynolds owns about 1/4 of the company. And Disney is preparing for a proxy war with activist investor Nelson Peltz. Peltz nominated himself to the board in what could become a highly public debate over CEO Bob Iger's leadership. Meanwhile, the executive chair of Nike, Mark Parker, will take over as Disney's chairman. He'll advise Iger and the board in finding the CEO's replacement. And that is your latest business flash. Alex?
All right, thanks so much, Ritika. So, Guy, I do find this quite interesting in that this is a recent development, right? I mean, it's not that long ago that Nelson Peltz didn't own Disney. So, like, what is he seeing potentially in the stock right now where this is all coming to light?
What I think he's seeing in the stock right now is just a lack of focus, I think. And I think that is an accusation that has been leveled at Disney. We've had quite a lot of turbulence. The fact that Iger's back tells you everything you need to know in some ways. This is a company that maybe needs to get to grips with the cost story, needs to focus a little bit more on the bottom line. Though I have to say, just anecdotally, speaking to people that have just come back from the parks in the States, their view was that this was a setup that was just making money hand over fist. So clearly at the top line, maybe they're doing something right. Maybe at the bottom line is where the problems lie.
Let's get a different view. 23 past the hour on the West Coast. When I get to the startup, we cover all the top tech stories from the Bay Area and beyond. As Silicon Valley wakes up this morning, we're going to be joined by Ed Ludlow, who's in New York, but he's still plugged into the West Coast, so it's still kind of 7:30 where he is. All right, what are we hearing about Disney? What are people talking about?
I think it's what is Peltz trying to achieve, right? You know, Disney's a stock that fell more than 40% in 2022, you know, trailing the S&P 500. You know, what is he? He's an activist investor. He wants a board seat. But actually, if you look at what they're asking for, they want the company to deleverage. They say, you know, some of the Fox assets that Disney paid for, way inflated, paid too much. They want to reinstate or kind of take a look at the dividend for 2025. And actually, there's some sympathy out there. I think Rosenblatt has a note outright saying, you know, the problem is they're not asking to remove Iger. They're just saying, this has been a problem for a really long time, 2005 to 20. You know, Iger was very popular, but he had to constantly rethink about his own departure from the company because there was never an appropriate replacement, you know, or successor. These are all still issues, and it seems like, you know, Trian and Peltz are saying, same problems, put me on the board, I've got a track record of fixing these kinds of things.
Is there any signal from Iger that he recognizes this as well? The fact that he's back tells you something, doesn't it, Ed?
Yeah. Well, you know, this was a story of the year right at the end of the year. You know, as Alex was saying, right, so Trian, I think we found about their stake in November, right? It was 800 million at the time. It's been built up to 900 million. He comes out of retirement, right? You know, Chapek's contract was very recently renewed before he was dismissed from the company or left or whatever. So it shows that this was a very quickly made decision. What we don't have a good handle on, and this is why I love earnings season, is like, what is the strategy here? And, you know, I think a lot of what Peltz is pushing for is some pretty boring company management finance stuff. I'm a tech guy, right, guys? I want to know what the strategy is for streaming, investment in content. I love the parks, right? I don't think that's necessarily what Peltz is pushing for. You know, what we understand from the proxy filing is he wants some prudence and he wants a plan for who's going to be Disney CEO long term, because, you know, Iger is here temporarily and he's helping lead that search.
What do shareholders want? Where do they stand? Do we know?
Yeah, I don't think we do know. I mean, there are some big names that Peltz is appealing to. Remember, you know, in the latest kind of board changes and the change in the executive chair, they rejected Peltz as a board member, right? Disney's existing board. He's basically appealing to some big name investors saying, you know, put me in, look at my track record. The stock is higher, 3.3%. Is that a big mega move, or is that a post-inflation Fed read? No idea, but, you know, if we go on the logic that the stock's higher causally because of this proxy filing and what Peltz and Trian are doing, then I guess investors like the idea.
Tesla's trading 120. We're down another, let's call it circa 3%. Yeah, precisely. Here we go. Just another reason. This time it looks like it's China. Ed, how much are we going to break 100? We're 120 now, so 100 feels like a little way away. But we got there close. We got close recently. Can we continue to take this kind of a hit?
Yeah, it's interesting. We covered in the tech show last night the idea that Tesla is Goldman's top pick for 2023 in this space, but they also cut price targets again. Second time in quick succession. It wasn't that long ago that Goldman had a $400 price target on Tesla. Now I think the target's down to $205. When we had the inflation print, I thought, that the logic would be Tesla would push higher because this is a stock that trades 25 times forward earnings, and a lot of the tech bulls came out and said, 25 basis points going forward is really good. I thought Tesla would be caught up in that debate. We're down 4%. I think there's still concerns about China. I know that Bloomberg News reported, according to sources, a delay in upgrades and capacity expansion in Shanghai because of some data issues. But really what the market is still concerned about is the demand question, particularly in China.
Can we go to the chips problem too?
Oh, here we go. Come on, let's keep it going.
Yeah, he's like rapid fire me. What did we learn from TSMC? The stock was up, sure, but it didn't sound great.
Well, okay, so I think the guidance for fiscal first quarter revenue is slightly below analyst estimates. The street looking for 17.9 billion. They're looking at somewhere between 16 and 17.3 billion. They cut capex, $32 billion to $36 billion for the year. That's down from 36.3 billion in 22, so it's a modest cut. And they gave a narrative where the first half of this year is weak, the second half is better. Crucially for them, the supply crunch on those very basic chips that go into cars, that apparently is going to improve the availability of supply, and they will see growth in the auto sector in 2023. A very mixed bag, but the ADRs are higher when last I checked. So I think the idea is consumer electronics weak, cars will get better, they're reacting, the market's cheering their reaction.
All right, Ed, appreciate it. That's rapid fire for you. Yeah. You're going to take a break. Go get a cup of coffee. Ed Ludlow joining us from Bloomberg. All right, we are also awaiting announcements from President Biden at the South Court Auditorium on inflation and the economy. Alex Wayne, who leads Bloomberg's White House coverage, is joining us from Washington. Is this going to be a victory lap here, Alex?
A little bit, yeah. I think this is. I think the White House thinks the economy is heading Biden's way going into his re-election year next year. He got low unemployment last month. Now inflation is easing. Inside the White House, I suspect they think that they might actually pull off the soft landing they've been hoping for.
Alex, if gas prices go back up again, is that victory lap going to be a little early? Everybody we're talking to says oil is heading higher.
Yeah, it's funny to me how much gas prices really do affect politics here in the United States. That's a huge concern for the White House, of course. If we wind up with $5 a gallon gas again in the summer, going into 2024, big problem for the president. And I would expect you would see him again try to put pressure on Saudi Arabia if that should happen.
Well, Alex, that's kind of an interesting point too, because they're out of levers, right? Like the SPR has no more love to give at this point, and if anything, they need to buy it, which is going to create a floor for the price. So in some ways, they're a little bit out of options on that. What do they do if we're looking at a harder landing, at a more severe downturn? Like, what's on the bucket list of stuff they got to get to?
I think if the economy starts to run off a cliff, this White House is in a bit of trouble because they're not going to be able to agree to many emergency measures with this Republican Congress, the Republican House. And so it's going to become really a public messaging battle. The White House will break out every PR tool in its box to try to convince Americans that whatever's going on in the economy is not the president's fault and that he understands their pain and he's going to do his best to alleviate it. But you're right. They are not going to have a lot of policy tools they can turn to because of Republican control of the House.
Alex, more headlines over the last half hour relating to classified documents and the president. Is this an irritant or is this turning into a big problem?
I would say that right now it's an irritant. I would, as a journalist and also as a citizen, I would like the White House to be a little more forthcoming about what exactly is in these documents and how they got to these places, and to what extent the president was involved. The president told us the other day that he was surprised that anybody found any classified documents in his office, that he doesn't know what's in them. But now, according to this White House statement that just crossed, they found more documents in his garage. Now, I feel like it's a little bit more difficult for the president to claim he doesn't know how documents got into his garage, or that it was a surprise that they found anything there. So the White House has questions to answer here. I don't think this is going to be much of a political issue in 2024 if they can clean it up relatively quickly, and if this is the end of it. If there are more documents that turn up elsewhere, we're starting to draw, I think, stronger comparisons with what happened with former President Donald Trump in August at his Mar-a-Lago resort.
Alex, how does this actually happen? Like, literally, how do classified documents make their way to Mar-a-Lago, make their way to a garage? Like, I don't understand.
In Trump's case, we have a pretty good idea of what happened. His aides packed up boxes in the Oval Office as he was leaving the White House, and just threw classified documents in those boxes and shipped them to Mar-a-Lago. We don't know whether he ordered those documents to be put in those boxes or whether it was just kind of like a mad dash cleanup and they wound up there. But it seems like some of these documents were meaningful to him, that he wanted to keep them. He didn't want them to go to the archives. But with Biden, it's much less clear how these documents got to where they ended up. We don't know whether the president himself took them from a government facility as he left the vice presidency in 2017, or whether these were aides that, again, were, like Trump aides, were packing up boxes and accidentally threw some stuff into the boxes that wasn't supposed to go to Biden's house. These are questions the White House really needs to answer. I expect that the White House Press Secretary, Karine Jean-Pierre, this afternoon is going to have an interesting briefing with Washington reporters.
Yeah. I think you could be right about that one. Certainly one to watch. In terms of how this progresses from here then, is this something that Congress is now going to take an interest in? We've now got the Republicans leading the House. Yeah. How does this process now unfold?
Yeah, they've already written to the archives and to the White House counsel's office asking for more information about this. That's kind of a first step in a congressional investigation. Next comes the subpoenas. After the White House counsel's office refuses to cooperate, the archives will probably cooperate to the extent they're able to, but since these are classified materials, the Republicans will have, I think, a little bit of difficulty getting all the information they want from the government about what happened. But yeah, this is good. This is going to be an issue. The timing is really bad with Republicans in control of the House from the White House's perspective, because if Democrats still had control of both chambers of Congress, they'd have a little bit of an easier time with the legislature. The investigations would take a softer touch, frankly, if there were any investigations at all. So it's I think it's actually, this is maybe a good thing for the American public that Republicans are going to be in charge of one of the chambers of Congress, so that this whole incident can get a very thorough look from lawmakers.
Hey, Alex, before we let you go, we are still waiting for President Biden in South Court Auditorium to speak about the economy. The conversation that we're having in the markets is, does the Fed downshift to 25 but still get that terminal rate above that 5% and stay there for a while? What does the White House want the Fed to do? I appreciate they're separate, but what does the White House want to see from Jay Powell?
Yeah, the White House is very careful about trying not to look like they're telling the Fed what to do. They want to draw a distinction between President Biden and President Donald Trump, who really had no compunction about telling the Federal Reserve what to do. And so they've been careful not to say where rates should go, what Jerome Powell should do with the board. But I'm sure that in their heart of hearts, they would like to see a little bit of a slowdown on the increases. At least, I'm sure they'd be happier with 25 basis points than 50. I wouldn't be surprised if there are people in the White House who would really like to start seeing 0 BPS increases.
Yeah, no, exactly. 0. And the market's still pricing in a cut at that point as well. Alex, hey, we appreciate you. Thank you for walking us through all that's going on in D.C. right now. Alex Wayne leads Bloomberg team that covers the White House. Thank you very much. All right, let's just get a check-in on the markets here. it's a confusing trading day. The S&P is now up by 0.2%. The bond market also now seeing a bid in a different way. We were seeing some selling on the back end. That's now shifted. Want to get an update here with Bloomberg's Abigail Doolittle, who is tracking all of this. Abby?
Yeah, Alex, I think you've just named this trading pattern here confusion. I mean, take a look at these moves up and down as investors try to figure out what to make about this spot on CPI print. Now, of course, some on the street were expecting it to come in better than expected. That did not happen. Right now, a small gain for the S&P 500, a third up day in the row, when the NASDAQ had been higher not so long ago, a fourth up day in a row. I think a big driver for the gains, if they can hold out, and I should mention the volume is very strong. On the open, it was a double the 20-day anemic average, right now about 13% above, but it has to do with the year-to-date picture and what's happening today for the dollar. If we take a look at the S&P 500 on the year relative to the dollar, take a look at this. This is the story. This is not the story that we've seen over the last year, but it is the story of 2023, at least so far. The year's very young. And if we take a look at the technicals, the S&P 500 is doing something that it's done many times. And Ed Yardeni recently saying that right in here is the bottom. Here's the congestion pattern. Now, this congestion pattern, the trading range that we've been talking about, the S&P 500 hitting up on the 200-day moving average, the RSI not even close to being sold or overbought, excuse me. This congestion pattern, we don't know what way it's going to break, that range. That's the battle between the bulls and the bears. Right now, though, there's some early signs that it could go to the bulls, especially given the fact that the Dow is well above its 200-day moving average. So is the DAX. Maybe the S&P 500 is late to the party. These stocks, though, they are certainly in party mode on the day. Disney up 3.5%. It seems that shareholders agree with Nelson Peltz's proxy bid to get to be on a part of that board to improve the share price, a succession plan for Bob Iger, plus the debt and some of the high-priced acquisitions. American Airlines, good numbers out of this company, up 5.4%. And then Microsoft and ExxonMobil, just to show how broad-based today's rally is, guys. Pretty solid, even though the S&P 500 itself right now up just modestly.
Yeah, it's interesting to kind of break out all the components, take a look at what is happening. Some really interesting stories below the surface. Abigail, thank you very much. We are awaiting the president. We got the 2-minute warning 15 minutes ago. Kind of tells you where we are in this rundown. Anyway, we understand that he will be appearing fairly shortly. We await his comments on inflation. I would imagine that there is also a focus on what is happening with these documents. Anyway, 2-minute warning 15 minutes ago. At some point, we're going to hear from the president. This is Bloomberg.